Mm.
Good morning, everybody. Welcome to the new week. Fun and games yet again today, overnight. Morning, Stel. Morning, Kay.
Morning. Having fun yet?
Again, chaps.
Do you guys hear me?
Yes, we can hear you, yeah.
Okay. So I was trying something but with my microphone, but it doesn't seem to function. Okay, go ahead. Sorry.
Yeah, no worries. Yeah, all fun and games again. Hope everyone's got clean underwear on for today. There's a few spoiled pants, no doubt, in the market. I trust everyone is trading safely. Obviously, the pound's going to be the focus of a lot of what we're talking about today, so I'll get through the bits and pieces in the headlines in other news quickly, and then we'll have a look at that. Right, a few bits and pieces going on, a few comments out of Japan. Just to pick out some of the, I'll call them key comments, but interesting comments. Another one of the ex-FX diplomats, Shinohara, was out saying that the Ministry of Finance, Bank of Japan, won't defend the 145 level. This is, again, as we've been saying last week, understanding exactly what the intention of intervention is. It's not to set particular price levels for the yen, it's to take out the speculative and volatility from the moves. I think we're probably going to find a lot of people who are going to be leaning on 145, thinking that it's going to be a number that they're going to defend. There is a strong risk that that doesn't happen and we go through it. As long as we're not seeing 200-300 pip moves a day, if this grinds up over the course of a whole day, from here to 145 and through, they're unlikely to be looking to intervene. It's all about the volatility. So be very careful if you're leaning against 145. By sheer weight of numbers, there might be some decent resistance into that, but I wouldn't bet the farm on it. On the inflation front, we had Bank of Japan's Amamiya coming out saying the economy is picking up and inflation is going to accelerate into the end of this year before slowing down next year. We've seen that in the data that the economy is picking up. We're seeing the better numbers all round from the data in largely. Obviously, CPI has been picking up as well. If you want to take an indicator, then look no further than McDonald's, who has said to raise some prices on products in Japan by 10 to 30 yen. So there you go, direct inflation, as you can see it there. And we've also had Suzuki out overnight, pretty much with the same old comments. Kuroda as well was coming out saying rapid FX fluctuations are undesirable, but they won't hesitate to keep easing, and that if they raised the yield curve control, that's equivalent to a rate hike. Kay, what do you make of all the Japanese comments this morning?
Yeah. Well, first of all, the Shinohara-san is an ex-MOFer. It's the same as Sakakibara. They can have their own opinions, but they're not in the seat. So I'm not sure whether we need to take their comments for reality or knowing what's going to happen, because Kuroda said himself this morning that the MOF is the decider, and they can talk about stuff, but they don't know themselves when MOF decides to press the button. Well, we can take that with a little bit of a bag of salt, I guess. But anyway, he was also out saying that he's pretty sure that inflation will drop back below 2% next year. He also said it's not time to change anything, but that they may be some very minor tweaks to forward guidance. So he left the door open to some sort of change, but then in the same breath, he's saying that widening the YCC or letting yields go higher is equivalent to a rate hike, and he's not ready to do a rate hike. So a bit of everything and nothing at the same time. In specifically for the yen, I think they're in a bit of a trap, and yen is really in a trap right now between what happens on the yields front, Kuroda keeping his hands still right now, and also they have a negative current account and a negative trade balance. Everything works against the yen right here and now. So the only thing propping up yen, really propping up yen, would be interventions or some sort of coordinated interventions also. If the rest of the countries are starting to panic, such as the UK or perhaps Eurozone, now we're on the approach of 0.996 and 95, and pretty important levels there as well. But everything is still working against the yen, in my opinion, if you look at the fundamentals, which would be driving the currency. I agree. We've said it many times. I don't think they want to defend the level. Otherwise, they would go and sit on top, sit on the offer, give their agent banks the orders to just go and sit on the offer, whether it be at 144 or the big one 145. They may even not wait for 145, but because I recall last time they intervened, not the last time they intervened, but when they intervened at 105, they were sitting on the bid at 105.5 and not 105. So we can't stick a number on where they are going to be active, unless, not unless, but albeit we know what they don't like. It's the plus 200-300 pips moves. So that's the only thing we can bank on. The low today is what, 143, 143.17 apparently. So I guess anywhere close to 145, 2025. We have to be really, really careful. But if it goes up and the rest of the dollars are rising, there's little they can do by just go and sit on the offer. So if they want to kill the speculation, in my opinion, they need to put it below 140, and I don't think there's any fundamental reason for dollar yen to trade 5-10% lower right now.
No, that's agree, mate. Yeah, I think you're absolutely right. Stel, you got any thoughts on this morning in the yen? Are they going to be stepping out, or are they going to sit and wait?
Tough one. I mean, you guys are much better on the yen than I am, but I think what they've been doing so far, I mean, I don't know. I think chances are they're probably going to sit and wait a little bit and see what happens. But I really don't know. I don't know what to make of them. And really, I haven't traded the yen in 2 years. Literally, I just don't get it. So I tend to avoid stuff that I don't understand.
Yeah, no problems, mate. No probs. Right, into some of the other news. The OEC cut global growth for 2023 by a few pips. They kept 2022 unchanged at 3%. They also raised the Eurozone's growth forecast for 2022, quite surprisingly. And then they cut 2023. I'm not sure if they got their numbers around the wrong way on that one there. The IFO in Germany was out this morning. Pretty crap numbers, as you can see there on the calendar. Bad all round. The comments from the IFO were pretty negative as well. Nearly all sectors are showing in a minus, as they call it, based on their metrics. Inflation is still rising strongly and is being passed on in more than 1 in 2 firms. So there's no let up in inflationary pressures there, no let up in the situation in Germany, the so-called growth engine of Europe. Quite surprised if we're basing what happened in the pound on the fundamentals. Quite surprising that euro dollar didn't clap 600 pips on those numbers, but hey, that's where we're at. China, there's been a few bits and pieces out. A bit of waffle on Russia. Again, it's a bit more fence sitting, hoping that things calm down over there, but nothing really you could say strong either way. So they obviously want some de-escalation over there. But then they're entering deals with Russia and India, I think, this week. Russia and Iran, I think, this week. So, you know, again, talk out of both sides of their mouths on that one. But their NDRC did come out. That's a National Development and Reform Committee, saying that they're going to accelerate infrastructure spending. This is China's way of getting GDP moving by chucking loads of money at infrastructure projects, which obviously brings a big development boost, and that can raise activity. Whether the market is going to see through that as false, let's call it false accounting, if you like. Infrastructure spending doesn't necessarily lead to a prolonged period of sustained growth. Obviously, depending on the timeline, you know, once you've built so many roads, factories, and whatever, you need the activity to put those to good use. Whether that's going to happen, I'm not sure. Just looking at some of the other data, not too much out. We've had a few ECB speakers, again, waffling on the same things, setting their stalls out for what rate hikes are going to be over the months ahead. Some going for 50s, or the decision will be 50 or 75. Japan's PMIs were out overnight as well. Again, a little bit of divergence that we saw last week between manufacturing and services. Manufacturing dipping to 51 from 51.5, services up into expansion 51.9 from 49.5 prior. So as you can see, they're a bit more divergence. Both numbers still in expansion, which has been the theme for Japanese data of late, that we have seen improving data over there. Guys, you got any other major headlines out that you've seen? There's been a few, but
yeah, it's the Italian veering to the right.
Oh yeah, the elections. Yeah.
Yeah, Italy's right wing won the election, so there may be a bit of doubt around what's going to happen to the Italian bonds again. So she did try. Meloni is her name. She did try to say that she is going to respect everything that's been put in place, but we can never discount any comments because she's anti-European. We have to look at the spreads between the Italian and the rest of Europe, especially German spreads, which are widening a little bit this morning, but not yet completely flying away. So we are sitting at about 238 basis points, Italy versus Germany. But if they would start to widen, it's going to be yet an additional weight around euro's neck, possibly.
Yeah, definitely. Right, well, let's get stuck into it then. Obviously, the pound move is a big factor here. Now, we know the situation. We had this mini budget last week. The market hasn't taken kindly to it. As expected, it's been picked and pulled apart by all the economists and analysts and everyone you could counter. It has meant that there's a likelihood of the UK Treasury having to increase borrowing to pay for all this. That's not gone down well with markets. Completely understandable what we saw partly last week in the moves in the pound. This move overnight has come at a pretty illiquid time. Whether it's someone trying to push the buttons of UK authorities, not sure. The fact that we've bounced all the way back to 108 suggests what the real fundamentals are at the moment. This does look like an outlier move. We did see moves in other pairs. Euro dollar was down to the 95s. Some of the others not doing too much, Aussie dollar and the like. So this theme is still in play. The UK looks to be getting the treatment for potentially what's going to happen elsewhere. I mean, you can look at the UK cutting some taxes, and pretty unimportant taxes in the grand scheme of things. A lot of public stuff, you know, things like inheritance tax, that sort of thing, is not wholly huge for an investment point of view. But it has been taken a bashing over it. But if you look at all the other countries, they're all going to be doing the same. You know, the Eurozone's got their recovery plan, which is budgeting for 185 trillion. You know, they're all going to be at it. They're all going to be raising funds via borrowing into an interest raising world. So why the UK is being picked out, I'm not too sure. I think that move overnight doesn't reflect the full fundamentals. So I think we've got to be very careful here. What it has done, it's given us the flush out. As we get that move lower in the quid from the 112s all the way down to the 108s, it's just pretty much triggered a flash crash, not too liquid. Sellers have just come in, cleaned it out. Now we need to see what happens next. Are we going to return to those lows, or are we going to find some semblance of support? But for me, this doesn't reflect the fundamentals of what's happened in the mini budget at all. Even if you take
Ryan, sorry to interrupt. I was just going to say, it's not the mini budget itself. It's the fact that whatever the name is has said that there's a lot more coming. That's what the market, I think, is afraid of. And I do agree. It's not, why is the market picking on the pound? Probably because it's the first one out of the blocks, doing these things. So, I agree. I think it's going to be happening pretty much everywhere. But the pound is getting pounded now, and that's that's where we are. So for me, the problem is not the mini budget itself, is rather the markets are now expecting quite a bit more to come.
Yeah, and that was out on Friday as well. That Truss said that they're going to do more tax cuts. I get the move down. Don't get me wrong. I get the move down that we had on Friday. I don't get this move down overnight. That to me
that's low liquidity, people pushing the market, trying to get stops out, all sorts of games. So yeah, I agree with you.
Yeah, so here we have a situation where a lot of people were looking at UK gilts on Friday and saying this is driving the move in the quid. Well, we've gapped up higher, and yet the pound is only off, has been only off 50, 60 pips over Friday's close. So if you're looking at on Friday that we had a 60 basis point, 70 basis point jump in yields, and here we are tacking on another 40, yet cable's only down 100 or 50 to 100 pips. That's not reflective of the mood. It seems, as I say, there's two elements here. The first move we got on Friday, which I fully understand, this overnight move, which is illiquid. Now we're seeing yields still rising, but the pound isn't dropping back as far. So, that's probably more reflecting fundamentals now than what we saw overnight. Kay, what are your thoughts on that one?
Yeah, well, the thing is, the market didn't like a combination, right? It didn't start last week. This move lower in sterling. I think there's a big problem of confidence in the Bank of England being able to cope with whatever comes around. And it started with Bailey himself saying, we are going to raise rates, but then we are not going to sell bonds yet. And then, but we think we're in a dire situation. Then the market takes a bit of trust, saying that acting up again, playing up again, or making comments around Brexit. Then we had this mini budget with maxi implications, where against all the tax cuts and against all the help in for the, let's say, the man in the street, they're also taking away the cap on bankers' bonuses. Perhaps they hope to get some more taxes in from there and to save the City of London. But the problem with all that is the market stood up and said, like, well, who's going to fund all that? Because you're cutting taxes, interest rates are flying, so the government needs to borrow more. We're talking about possibly 150 or so billion sterling. It's big, and the market just lost confidence in the currency. But it's been brewing, right? It's been coming for weeks now. And yeah, it's just a confidence crisis. I think perhaps the whole situation over a longer period may end up helping the sterling, the City of London, to alleviate some pressures on prices for the man or the woman in the street. It may help in the longer term, but in the short term, the the market got a bit of a shock and has absolutely zero confidence in the Bank of England to find a solution to it. And I think that is what we are seeing now. And as you say, we have seen the flush. I would think that as well, we have seen the flush. I'm not sure whether there's a case to take cable per se down to parity, but then now that this has happened, we look at the other side of, if you talk about cable, you look at the other side of the pair, which is the dollar, and give me one fundamental reason now to sell dollars. And so in a way, I think the problems for sterling may not be over until somebody says, okay, this is enough, whether it be coordinated, whether it be Bank of England saying, right, guys, I mean, this level of sterling is going to kill us. We need to do something about it. But then again, you're fighting against fundamentals like the MOF is doing in Japan. So I think it's more a case of the market abandoning any confidence that they had in sterling, than really saying we want sterling to trade lower. I'm seeing and reading and hearing a lot of similarities from when the sterling left the ERM, but the situation is different, right? There may be some price action which looks the same, but in those days it was a system, and the system didn't work, and now we're gone. This time it's different. There's a crisis of confidence in the UK being able to handle the dire situation.
Yeah, and I think it's also important to note that it's not just the UK. The UK, just as we say, is just in the crosshairs at the moment. But you know, look at how all the other pairs have reacted in the dollar. You know, Aussie, Kiwi, Euro dollar. You know, the pictures are the same in all these dollar pairs. The fact that you know, the pound has accelerated just on this situation, as Kay points out, loss of confidence in Bailey in the UK is absolutely right. But the overriding theme has also been this dollar strength. And what the problem is here is that there's a global worry about the economy. I mean, you only got to look at oil markets. You know, look at oil, well below $80 now and heading lower. You know, there is a problem with the market globally thinking that there's going to be a huge recession coming, and everyone's going to get hit. And at the moment, when you look around at all the countries, it's a question again of who is the least dirty shirt, and the least dirty shirt is the Fed or the US, and they're going to continue hiking, which could invariably, as I say, look in the longer term, be a bad thing for the US, because if they've gone from one extreme to another, i.e. thinking inflation was temporary, and then they don't need to hike as much, and now they're going the other way, and rates might get to 4, 5, 6%. What's that going to do to the soft landing that they expect? And even Powell's worried about the soft landing, as we heard last week. Now, if the US really hits a brick wall hard, that's going to tip global growth worries even further negative, but it's going to hit the dollar. And then you're going to find a question of, right, well, where's money going to run to? If it's running to the dollar on safety, on yield, where's it going to go elsewhere? Then we're going to start to see metals picking up. Then we're going to start to see the usual safe haven flows, even cash picking up. But this is all long-term stuff, and you know, this forms part of the fundamental picture that we look at day in, day out. But if you look at, as I say, look at some of the metrics, gold, metals, things like that, it's not looking hot on the growth front, and that's going to be the big main driver for prices at the moment. So what can we do about the pound then? How do we trade the pound right now? For me, I'm sitting out. I did start buying it cable on Friday. I did come into the chat room because I thought that the move that we saw on Friday was excessive and overdone. So I was going to be buying it all the way down to 105. I got in 2 orders, 109 and 108.05, and got stopped out overnight, which has actually saved me some money because it meant I wasn't going to get in with other bids or any other entries on the way down. So small mercies for that one. But here we are. How do you trade it now? You know, in 15 minutes, we've gone from 15, 20 minutes, half an hour, we've gone from 108 to 107s again. It's very choppy at the moment. I think trading it here in the middle is going to be very dicey. You know, what you want to be looking at is, if you want to be trading it, okay, we found a boundary at 108. You know, maybe look down here, 106.60s, where we've had at least some amount of support being seen there. This is what you want to look for in the price action. Look down here, 105.70s, 80s area. Bit of resistance when it first broke down. Now it's become support. If you're going to be looking to trade cable, look for these moves that are backed by a bit of time. It's no good just jumping on single candles. Look for the price action to build up and give you somewhere to trade it. Me personally, I'm not looking at trading cable right now. I've already had my fingers chewed off. Not looking to get back in anytime soon. Euro sterling, you know, what a move that's been. All the way back up to the pre-Brexit highs just before Brexit happened. All the way up there, and now we're all the way back down again. It's very, very messy at the moment for the pound. A lot of uncertainty here. Again, I'm not really looking to trade it. There's plenty of other opportunities around. Guys, you gonna any of you guys looking to play the quid?
Well, you know me. I've been calling euro pound to get to 90. It got to 90, and it went right past. Do I play it now? No, I think I've been telling myself for a while, if we get to like 92 handle, I'm going to be shorting that. Obviously, I didn't leave an order on. That would have been nice because it would have been filled overnight. But at this point, I'm not touching it. I really want to see how things develop. You know, it's one thing to have price levels in mind. It's another thing to have such elevated volatility and the possibility of something happening that completely shocks the market one way or another. So for me, it's too much of a risk and too much of a gamble at the moment to actually do anything on the pound.
Yeah, no, I agree with you there. Kay?
Yeah, I'm in a similar state of mind. I still think the dollar is the best what there is out there for the time being, until we see either the Fed calling a halt to the bond market, or we see data materially worsen. And I'm thinking about jobs, the labor market, or inflation coming materially lower for longer. So I'd still look for levels in the cable to get short again. I was actually thinking this morning, come on, BOE, give us an emergency rate hike, put it back at 110 and 111, so we can hit it again. But yeah, I don't think on its own there's enough strength in it. So really, if I would do anything, it would really be stab here, there, quick trading in and out, and I can't see what I need to do here on a more medium-term basis. People are calling for parity. Other people saying parity is a stupidity. I'm not ruling anything out in this scenario. Although, as I said earlier, I think the big flush has happened. Now we have to see what happens over the course of today, tomorrow, especially. If things don't. If we don't get anything from the Bank of England, or if we get comments saying that they can't do anything about it, then yeah, why not go and visit parity for the end of the week? I don't know. Yeah, it's going to be short-term stuff if I do anything.
Yeah, and yeah, Gavin's just put up a thing there. It's just out on Sky that some of Liz Truss's Tory MPs, Conservative MPs, are already putting in letters of no confidence as they fear she's going to crash the economy. So claims a former minister. So, as always, don't ever rule out the ability of the UK government to shoot themselves in the foot there. Amador asks, what can the BOE do to stop the decline? Pretty much nothing. There's obviously a lot of talk about whether the Bank of England intervene, either with emergency hikes, intervention directly into FX markets. in my opinion, that will do nothing but make the situation worse. Probably the best thing they can do now is just sit back, let the market do its thing, but at the very least, just come out and say, you know, you can do what you want, market, but we feel no need to panic and will not be pushed into any moves. Whether they do that or not, or whether they are pushed into doing some silly moves, remains to be seen. Often we have a thought of what they should do versus what they actually do. But they will do nothing if they hike rates, except maybe increase the panic, because then that's pretty much them admitting that there's something wrong, something broken, and they're panicking to fix it. So any hit or any boost to the pound over that likely be short-lived. But as I say, we can never say never with these clowns. Would it be the right move? As I say, I don't think so. But they're going to do what they're going to do either which way. And the same goes for the government. You know, the intervention they can possibly do, they're already doing it. They're cutting taxes. That's their intervention. They're going to try and growth their way out of this situation. That's what their aim is. And they are taking a pretty big gamble on that, with raising debt to try and do this to fund these tax cuts. But as Kay says, how it turns out in the next 6 to 12 months, we won't know. It could be a blessing in disguise for the UK economy, that those tax savings help boost the economy, stop people, you know, going too deep into debt and that sort of thing. Who knows? It's all going to depend on energy prices and everything else that's happening in the world. Kay, do you want to do your little round robin on the bits and pieces?
Yeah. To be perfectly honest,
just pick a couple of two. Yeah, just pick a few pairs to have a look at, maybe.
Yeah, sure. Just hang on a minute. I'll tell you when to yeah, you can release it. I can take over now.
Yeah, 2 6. There you go, mate. All yours.
Okay. So first of all, Dolly, and we've been talking about this, and do it a little bit shorter. So this, whoops. The what is this? Okay. So we've been talking about this intervention here. Since then, it's been gradually creeping up again, and we've seen overnight. And on Friday already starting to stabilize around 143. We had gradually creeping up, and yeah, today we're seeing a little bit more. So I think the market is it's not a testing mode because all the dollars are higher. So I think it's just a case of give me a reason to sell it, and if not, this in my opinion, there's a chance that we are starting to grind back to at least 145 and see what's happened there. I think in the short term, if we start to see it back below 143, and then especially here, I think is going to be a bit more important around this 142.25. We had a bit of traffic here. We had traffic here when it stabilized. We've seen that last week as well. I think this is, to me, the first more important level inside the intervention range. And then on the other side, I'm looking at this 144.40s. We've been trying, and we failed to stay above 144.25. But it goes back through 144.40s. I think there's a real chance for a retest of 145 coming. This euro yen, with all those negative data now coming out of Europe, and the euro getting stabbed, it was quite. I was quite surprised actually to see that the ease with those euro yen drops, we have to call it a drop, are holding. So I would be a bit in this 137.60 zone, down to 137, let's call it that way, and even 136.75. I think is going to be important for a hold or break if we ever revisit that. And going into the end of the month, end of quarter, I would only be half surprised if we make it back above 140, 70, 141. The figure it would only half surprise me, because the European market is still going to be deeper, and if the fundamentals kick in again for the yen, I really wouldn't be surprised if this creeps higher again. Same is valid for a couple of other crosses. And there's one interesting one, and I've said it already. I'm not a big fan of moving averages on in FX. I think they're much more valid in stuff like equity markets or harder assets, or let's say more real assets like gold and silver, for instance, like the metals. But anyway, forces to admit that we are hanging around this 82.40 in the Kiwi yen. It might be an interesting one as well to keep an eye on, because next week next week we will have the RBNZ again. And if they, as expected, raise interest rates by 50 bps, there's just going to be this mechanical effect of widening the interest rate differentials again. So barring any interventions, closes above this 82.40 zone and add 82.5 may see us slowly creep back up, perhaps to 84. Then we have to look, of course, at what's going on in the metals and in the oils. So we clearly have broken the other day through 1680, 7580. We had this little blip higher, it held, and we're coming back below. So now we've even broken sub those the trend line that I have here, since it's going back quite a while, and it has been traded, and that's why I'm keeping it. It has been trading on tops and bottoms here, and a bit of an overshoot here, but then so we are through here now. And to me, it has to go back above, get a close above 1652.55 to even have a chance to do those 25 bucks back up to 1680. But if we fail to get a close above, I think we are looking at 1613, and who knows if we have another clean out somewhere dollar related, and have a look at the mid to high 15s in gold. I'm not touching it right now. I think it's a little bit too hot to really get involved, unless you're already short, which I think Ryan is, and you ride out the train and start to think about perhaps lower and managing your stops or so. I don't know. I'm not in it. Either you keep it just above 1680, or you can even lower it when we get a daily close under there. Silver, bit of the same thing. It was holding pretty well for a while, but now the weight of gravity has set in, and I tried it on Friday to get long around this zone here in ahead of this low, ahead of this support. Didn't work. I'm out. I'm just watching the game. 1850 is a bit of a level, and then below there we're looking at 1830s. For the time being, I'm just going to keep an eye on things there, and I do have my long term still in there, because I think sooner or later, if everything recovers, this is going to take off. But for the time being, we have to trade what's in front of us, and what's in front of us is not really great if you're not long dollars. There's oh yeah, the oils. We're on the levels. I think 78 on the WTI, 78.40. We are right on there. And then 76.90 looks a little bit like the level of last resort for it to crawl back up or leave the ship. And we've seen what it can do for currencies. So I'm not sure what's going to happen on oil here. For the quietness and for the stability in the markets, it may well hold here and at least stabilize, if not start to rebound a bit. Otherwise, it could get a little bit ugly. Similar is happening on Brent. For long while it held those trend lines. We tested, and we held, and today we are equally in dangerous waters. We are below all those levels. We are trading around where is it trading right now? Yeah, but it's this is CFDs. Okay, we're trading a bit below, but in the CFD sphere, we're trading around 85.80. So we're still below the break zone. It needs to go back above 86.60. Ideally, go and retest the 89, or we may have a similar situation as in all the rest of the dollar pairs, and have a clean out down to 80, and why not below. This one is an interesting one, and it's been driven by the interventions. It's been driven by oil, but then look, okay, there's the yen side, but this trend line here, it looks a bit of a magnet, and we have a lot of support between 104.85 and 105.25. There's this 40 pip zone, 40 point zone, where there's quite a bit of support. We had an overshoot on the interventions on the 22nd, which came down to yet another support line, 104.5. But now we're trying, and I'm just got a little tad of it in the books right now. It's really small. See if we can gradually crawl higher again, but I'm going to need a little bit of help from the oils, and for the time being, it doesn't look brilliant. Quick look at what's happening in the emerging market sphere, the ones that we follow at least. Yeah, we're already at the next resistance, 716.5. We're back right there, and so I think we are sooner rather than later going to find out if 720 caps this thing. Whoops, if not, well, yeah, that's the thing. I'm not going further back than 2005 here. But if not, why not envisage something in the 740s, especially that China is still pushing the pedal to make things easier and more liquid in over there. So, and looking at the other side of the coin to the dollar is still very big as well, and we are now starting to find it back at in the dollar mix as well. The dollar mix is trying to go for it now. We've had the Friday, we just came into the zone, had a bit of a shoot, and then capped around this what I've said before as well. The other one that I was looking 2023, and it's now starting to go. So to me, dollar mix first of all needs to fail through 2020, and more importantly, has to come back below this 2015, 14, 16 zone to reverse. If not, there's a possibility for me that we pull higher in some more dollar pairs, especially keeping in mind the end of the month, the end of the quarter. Also, what we can't forget when talking about yen pairs, that we are in semi-fiscal year end in Japan, and so there may be some more books to be managed. On the I had something closer here around. I did close my Euromix, as I said, end of last week, because I'm a little worried about risk, and we did have a clean out down to 1930s in Asia, but again, it's a very low liquid washout, and we are now turning around this 1960s line again. Which was the 2017 low. So I'm cautious right here and now. I'm cautious, and I'm waiting to see if we can have at least a move back up to perhaps 20. I think the 2035-40 is probably a bit rich for now, but why not? If risk continues to trade the way it does, why not get a move back above 20 in that one? And the last one that I showed also last week, we had a bit of a move on the SARB, yeah, but these 17s are holding, and we are now already at the trading at 18, which I said was the risk, and we are right on this 78.6 now. So be a bit careful if you're involved in this. It could heat up if we get a close above there. If we start to falter, and then we've got about 2-3% to play with in this zone. But I'm still very cautious on any dollar shorts. Anyone? I guess. Well, no, it looks a little bit like a spaghetti shot. 36.40. We're trading 36.60 right now. 36.40 is a level under there. That's the S&P. Under there, I'd say 35.75. If this scenario continues, is going to be very possible. Why not even low 35s? And then we are coming back, and we have to we have to pay very, very close attention. If ever the bottom would fall out in the S&P, watch this 2020 top before the pandemic hit, and Stelios already hammered about this, hammering about this every day, and we hammering about this every day. This to me is going to be a level that the Fed is watching. If ever assets start to go below levels pre-pandemic, that may be some kind of really red flag for the Fed. So pay attention if we get a flush out in the S&P, and that really rounds it up for me.
Okie dokie, mate. Thank you very much. Let me grab it back. Well, I just want to touch on gold quickly. Kay was remarking there. I am short this. I took a bit more off my short at 36s this morning. I've still got my stop above this 70-80 area. Just for now, I want to see us holding below this 40. Let's get on to a shorter time frame. I want to see us holding below this 40 area. If I get that, then I'll start to bring my stops down, try and get them at least the balance to break even. I am looking for a move down to this 50 fib for another chop there, and then see what happens from that, and maybe tighten the stop up a bit more. As Kay mentioned, $1. This is one that I'm getting into as well. Oh, where's it gone? Up here. Right up into this zone that I've been highlighting about for a while, up towards 7.19. Again, this is purely a technical trade. We know that there's further easing possible from Chinese authorities. But again, this does look very, very US dollar driven, more so than one weakness. But I'm going to put some faith into the techs up here in this zone. I'm already in shorts and happy to add. We'll see what happens there. Really, for the rest of the day, you've got to be careful. We were saying last week that the risk of some sort of coordination or further comments from governments or central banks of other countries regarding dollar strength could start coming to the fore, and we get to hear something stronger, even the possibility of coordinated action. I still think we're pretty far away from actual action, but we could get some serious jawboning coming from the powers that be. So keep an eye on the central bank speakers, keep an eye on for headlines that may pop up during the course of today, this week. Dollar strength is becoming a big issue for everyone, not just the UK. It's an issue for everyone. So keep an eye on that. If you want to get a good grasp of which way the wind's blowing, keep an eye on the yield space. If you don't have some sort of watch list of the major yields, something like 10 years is all you really need, then get yourself something that shows you the yields, shows you what's going on in markets, because at the moment these are being the big drivers of what's happening, and all yields are on the up, even with UK yields accelerating. You can see here Italy, Germany, all following the same patterns. So it is a yield story, but at the moment the market wants to take the moves there into dollars. So be very careful. It's going to be a very, very volatile week, I feel. Headlines could be key coming out at any time on any of these subjects, particularly from the Bank of England or the UK. So be very careful here. I can't stress this enough. If you don't, I hope you do trade with stops, but if you don't, what you need is at least a disaster stop. That was my stop in the pound last night, 103.50. I thought that might keep me safe enough out of any volatile moves, but also if something negative were to happen, I've got something in there that will at least protect my account. That's what happened, even if my stop is on the low of the day. Such is life. I'd rather have protection than not. I'm going to be in control of my stops and my losses, no one else. So from that point on, I wish you a very good day, a very good week this week. Please trade safe, and we shall see what fun and games we have tomorrow. Have a good one all.
Cheers. Goodbye, everybody.